Of course, the most important factor is our own personal capacity and tolerance for risk. How big is our account size? How much are we willing to wager each day? Now, we still want to make sure that we maintain our strategy, and that is to have asymmetric trades on, trades that have extreme asymmetry, extreme risk to reward, because there's incredible benefit. And of course, our primary strategy is to collect premium on the 0 DTE event for S&P options. That's because on the 0 DTE event, we have the smallest window of time where we're going to collect the maximum rate of premium. So we combine the asymmetry with a premium collection, and now we have a real winner. Our third stool to this, or third pillar to all of this, is our process. Now, our process has to include our strategy and our day-to-day process, how we log and journal trades, etc., and our continuous improvement process, and then the situational strategies that we come up to. So our first consideration, obviously, is how do we get into the market? Now, surprisingly, getting into the market with 0 DTE trades is relatively simple. The way we get into the market is we simply set up a butterfly strategy, an out-of-the-money butterfly strategy. We push it way out of the money so that we can get the kind of risk to reward that we're looking at. Remember, I said a minimum of 1 to 9, and there is no compunction of going to, say, 1 to 10, 1 to 15, or even 1 to 20. That all really depends on the amount of volatility there is in the market. So if it's extremely volatile, we'll want to push it a little further out. And also, we might even want to go wider. Now, we could do this with any of these indexes. We could choose the SPX, the NDX, the XSP, or the E-mini futures. So there's this sort of almost not infinite, but there's just this incredible range of exposure that we can have every single day. Now, so that's how we size it. So we have all of these different choices. We can go with, we can go higher risk to reward, we can go the individual types of asset classes that we're trading, etc. Now, of course, we have two primary strategies where we put either a single classic fly out there, out of the money, and we usually use those in directional markets. And so that's one consideration, or any other type of market, either non-directional or volatile market. We tend to put on what we call the Batman trade, which is two out of the money flies, one above the market, a long call fly, and below the market, the long put fly. And so that gives us this sort of market agnostic situation there. Now, even there, we have to think about, well, when we put on two flies, we're actually creating twice the risk. When we put on two flies, we basically have double the debit that we normally have. We might want to consider pushing those further out, as an example. So again, there's another factor in the decisions that we have to make in terms of overall exposure. Now, we can point ourselves towards one end of the spectrum or the other based on some very basic things. So for instance, how much volatility do we expect in the market? If it's a very, very volatile volatility regime, it's kind of redundant. It's from the Department of Redundancy. Yes, much like what we had in most of 2022, that often, first of all, demands that we take a market agnostic position. In other words, we put on the Batman trade above the market and below the market because we don't really know which way the market's going. And now we have to decide on the overall size of the trade. Now, if it's super volatile, that's good because that means earlier in the morning, we can put on a much wider trade, push it further out of the market because we can expect some range. And so that will result in real capital efficiency because we can put up very little money for very large potential rewards. As an example, an SPX trade that we could put on that's 40 wide and then put it out of the money by, say, a 1 to 20, it's only going to cost us $200 to put on a trade that can conceivably make as much as $3,800. So that's cool. Really volatile market. We can have an exposure of only $200 for the potential of making $3,800. Now, can we expect to make $3,800? No, obviously not. But we still have that potential. And there's also a spectrum of profits that we can make between those. And when we go wider like that, that gives us a lot of great characteristics. When we can go wider and there's higher volatility, that gives us a lot more flexibility in our trades because we know wider flies tend to accelerate more quickly into their premium collection throughout the day.